Okay, good evening, everyone. Welcome to the Hurley Investments Market View Commentary, the last one for 2021. This is the last week for our commentaries and our trade findings and adjustments, and we will just get those set up for next year and get you guys registered, not starting until January 6th on trade findings and adjustments. But that does not mean we're readily available if you'd like to talk. All right, today I went through an interesting opportunity with one of my clients. And here's the question. The question came in about, well, it was this. Kevin, let's get that right. Kevin, why aren't we invested in something like ARK? And he was serious. He's like, man, we have this Cathie Wood. She's innovative. There's billions of dollars going into it. Why aren't we in something like that? And I'm going to compare Cathie Wood to Elizabeth Holmes. So if you're familiar with Theranos, little machine that you are going to get a pinprick, it could give you hundreds of different opportunities to understand your health, whether you had AIDS or this or that. I mean, it was all over the board from just a small little tiny drop of blood. She raised billions upon billions of dollars to find out she was 100% full of crap. And Abraham and Bill, I love both your comments. She lacked integrity. I don't know if Cathie Woods lacks integrity, but I do feel she lacks talent. And it was interesting because, if I can go ahead and say so, William presented me and said, Kevin, let's go to Morningstar. Let's take a look. Hey, Kevin, just to let you know, this is a 5-star analyst rating, right? ARK Innovations, 5-star analyst rating. And I went, huh, okay. Kevin, look at that growth. And I sat there for a little bit and I said, well, if I understand right, great growth, right? Supposedly. But I see a flat year. I see a flat year. I see 3 years with minimal growth. It only seems to have had 1 year of real growth, and then it's come back down. So with all due respect, I'm not sure I'm seeing the growth that you're seeing on the chart. In fact, he then went to like total returns, and I was like, you're killing me. You're absolutely killing me. Because I don't see it. I don't see those returns. And it's interesting because you can go through and I mean, there's, oh, it's this. I mean, you read through this and you'd think, oh my gosh, coolest thing since sliced bread, right? Fun analyst. I guess not bad above growth. Performance. Growth of 10,000. Again, I went through that. I disagreed with that. I found it interesting because, I don't know, it wasn't what I was thinking. And so I kind of dug into it a little bit. Oh, it's high risk. The beta's not too much off. Maximum downside risk is really 23%. That's it. In fact, somewhere in here, maybe it's the fund analysis. It's only like 75 basis points. Well, I'm not finding it, so I'm going to move to the next one. There we go. ARC analysis, assets under management, 656 billion, expense ratio 0.75. Actually, that's daily volume. Assets at 16 billion. It's just like, oh, this is amazing, right? You go through and you read all of our innovations. You're just thinking to yourself, this is ridiculously good. And it just came up on CNBC last week. In fact, if you went to her page last week, it showed that she was only down 2.57% year to date. I was like, no way. And I went to ARC. I went and I said, you know what? Let's do the math here. Let's truly find out. And William, again, I'm using you and not in a bad term whatsoever, but I said, let's really find out if things are correct. Because I expected it to be worse, right? I expected it to be worse, and it said only down 2.57% last month. And so we came over here and we found that's February. We found December, it closed at 124.49. So ARC closed at 124.49. And currently today, it closed at 94.50. So if you subtract 124, let me get a calculator here. If you subtract 124.49 minus 94.50, down 29.99. I'm going to do the math for you. So Morningstar says 5-star rating. Closed. Why is this not going a little bit better? Give me a second. Need to make sure it's the way I like it, or these little things just bug the crap out of me. Closed last year at 124.49. Currently at 94.50. Lost 29.99. You divide that at 124.49 equals, divided by 124.49 equals, it's down 24.1%. And it's just a loss. It's just blown out of the water. Yet CNBC last Friday was really pushing Kathy Wood and this innovation. And then I thought, you know what? I'm sorry, William, but I got to teach you, right? I got to teach you. And you're like, oh, come on. Is it really that bad? Summary prospectus, right? This is on her own website, so I'm not making any of this up. Fund, what it's about. And I played this game with them again. Kevin, it's cheaper than you are. It's only 0.75. No other expenses, no distributions, no nothing. It's a great position to be in. And I chuckled because she's a hedge fund. Pursuant to Sephard's agreement, ARC management fees pays all the other expenses of the fund other than fund fees and expenses, tax and governmental fees, brokerage fees, commissions, other transaction expenses, certain foreign custodial fees and expenses, costs of borrowing money, including interest expenses, extraordinary expenses, such as litigation and indemnification expenses. So right here was the first, hey, William, with all due respect, I call bullshit. Pays all expenses other than this whole list of garbage right there. And I was, I can't wait till I find the real returns that they go through. Hey, the turnover rate was 71%. So they are dumping 71% of their portfolio each year. 4% is the average and the expectation. Blah, 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 blah. Let me go to where I thought it was ridiculous. The risk was kind of funny. I did go over the risk. There's no assurance fund means there's no assurance that the fund will meet its investment objective. You should consider the risk before you go out the funds. And let me go to what I wanted to show you. And William, I know you're just like going, oh, Kevin, don't show that. Please don't show that. There it is. So I love those returns, right? But here's where it really, really was absolutely hilarious. The returns before taxes, 152.51%, right? Then you lose the 1.5%, pretty common. Sell off of 10%, long-term capital gains is 1.5%, because the fund has to pay its taxes. But then after taxes on distribution and the sale of the fund shares, people last year only made 90%. Can someone please tell me where that 60.5% went to? Because I know where it went to. Where did that 60.5% go to? Returns after taxes on distribution and the sale of the fund shares. Anyone? Usually it's a 2 and a 20, right? Jim, it is not overhead and fees. She actually takes, instead of 2 and 20, she's taking 75 basis points, not 2%, and she's actually taking 40% of the profits. It is worse than a real hedge fund. And what I thought was pretty interesting, just kind of in my understanding, I started doing a little bit of research, and finally I got some people that are talking about how poor it is, but they call it a nightmarish fund, and they really rip on all of them. But Where's that chart? I wanted to find the chart. Guess we had the chart, but what if I take this out to 5 years? It just, I was shocked. I was absolutely shocked by how crappy this looks in real life. And 1, 2, 3, 4, 5. Oh, I can't find it. I can't find it. I probably got rid of it, but as you look at their chart, the real rate of return for the chart over that period of time and the real growth minus the losses and everything, for 6 years, they've grown 12%. They basically have a 2% growth rate over the 2% period of time. It really, really, really is absolutely pathetic. Which brings me back to, and William gave me the idea, if you don't have a fund, and I'm also going to put manager, with integrity and talent, then you don't have a successful opportunity. You're just hosed from start to finish. And she is not one. And to take 40% of your potential profits since 2014 when the fund started till right now, in fact, it's worse. That's 7 years. 12 divided by 7, real rate of return of 1.72%. A real rate of return of 1.72%. If our inflation is 6.8% this year, her fund hasn't even beat inflation over the last 7 years. It's pretty interesting. Invest by facts, not emotions. I've showed you guys last week how I use valuations to justify what I get into. Doesn't mean I'm right. Some of you, Rich Mormon has teased me, hey, you sat on Ford for like 2.5 years and you said get to 22. And boy, to his credit, he's like, Kevin, I wondered what you were smoking. Just because it can calculate an valuation, it sometimes takes, let's face it, it sometimes takes sometimes the real return of what it should be doesn't happen all at once. And we had to wait a little while. Right now, boy, a lot of our core holdings, we're waiting on Boeing, we're waiting on Square, we're waiting on Disney, we're waiting on Visa, we're waiting on Baidu, we're waiting on Under Armour. We're not so much waiting on Ford. Ford's finally moved. Apple's doing pretty good. We're not waiting on Apple, even though there's still more upside. You got to invest by those facts, and those facts are simple valuations. I love number 3 for Warren Buffett, right? Buy wonderful business, not cigarette butts. And for those of you that maybe haven't ever heard this, as a kid, I guess he would go around and you could look on the ground, you could find cigarette butts, and you could just get a quick puff because you have a little bit of the cigarette left, right? But wouldn't you rather have a brand new fresh cigarette? Do you really want to put your lips on what someone else has been puffing on and licking and touching for one little puff of what was thrown on the ground? Shocking. Number 4, buy stocks that you understand. I can go as far as to say buy equities that you understand. And equities equal indexes, ETFs, funds, stocks, options, futures, Forex. There's a lot to understand. Some of you have asked, well, Kevin, don't you should invest in Bitcoin or Tesla or Amazon? And yeah, I wish I had. But again, there are no numbers that can justify where any of those stocks are in their price. And you guys aren't hiring me to speculate. We just went through real returns for this lady. They're not that. In fact, her chart shows you a 40% hedge fund fee. The reason why I'm not in any of Kathy Wood's real funds, it kind of comes down to this. They're losers. All of them are nightmarish. None of them have profitability. 1.71%, 12% total, 1.71 over a 7-year period of time? You gotta be kidding me. Do I wish billions of dollars would come into Hurley Investments? Totally. I would love billions of dollars. But I would not want to be her when the shit hits the fan. I put her in the same category as the Theranos Elizabeth Holmes gal. It's not real. It's garbage. It's absolute garbage. And when you look at her own stuff, you can see it. You can absolutely see it's garbage. I find it pretty interesting because I think it's very important when you see a good opportunity, take it. Don't sell unless things fundamentally change. Buy at a price below intrinsic value. Here's where it means the most to me. Number 1, integrity and talent. When I am lacking talent, I'm going to quote that, talent, I have long puts to protect that lack of talent. Some of you guys will notice, some of us might be really cash heavy. I've got profits from 330 on Baidu all the way down to where we're at right now. And from 330 to 250, we made up every penny plus a couple dollars more. From 250 to 200, we only made up about half. From 200 down to 160, we made up every penny again. I get it wrong. There are times when the stocks just won't move like they're supposed to. But as long as I can justify the valuations, as long as I can justify that they're supposed to move, for my lack of talent of trying to outguess the market on when things are going to move, I've chosen to use long puts to protect when stocks have an 83% chance of moving up or down within a 6-week period of time. And that really comes down to the 2 weeks before earnings and the 4 weeks after. My lack of talent or not being willing to admit that I don't understand it, I use those long puts to our advantage. Well, Kevin, it hasn't been so advantageous this year. Agreed, except for Baidu. Disney has 20% more shares of stock that can be added onto it. Under Armour, we haven't done a good job. Visa, we moved away to straight long puts, or long calls, excuse me. Ford, we've done really good. Thank goodness I've added shares there. We just do the best we can. Bank of America, another great one. Thank goodness last year we were adding 30% shares of Bank of America. It's really taken off this year. It's just having an understanding of the 7 principles to investing that at some time it's going to be profitable for you. William, you asked me why we're not in any of the ARK ETFs, because they're not cheap. They're ridiculously expensive. And it's someone else gambling with billions of dollars of other people's money. And then some people like us try to run into it or try to buy and sell it or use options on it. Don't gamble in the stock market. If it's not fundamentally sound, you have no right being in the position. If you haven't gone back to level 1 and fundamental analysis, if you haven't done your fundamental analysis on those stocks, if you haven't looked at prospectuses for indexes or ETFs, you miss the first step in success of trading. Fundamental, technical, sentimental analysis, all important. It's a 3-legged stool. And most people get the, oh my gosh, it's going up. I saw it on CNBC. I saw it on a chart. It's going up. At no time, period, is that a smart way to invest? Again, 1.71% yearly average growth on the ARK innovation. For every dollar you put in, you would have made almost 2 pennies for 7 years. That's the real rate of return on her investments. You've got to go back to the basics, and you've got to do fundamental, technical, and use some amount of sentimental analysis if you're looking to invest on your own. It's not rocket science, but it is ridiculously important. Some people ask me, why don't you use Morningstar? Well, Morningstar 5-star rating. I would dare to say I don't use Morningstar because their 5-star rating on her funds tell me she is an Elizabeth Holmes individual. I think that's her name. Pretty sure it's Elizabeth Holmes. 5-star is, for all intents and purposes, in my view, Morningstar, not 5-star. Morningstar doesn't have the integrity that Elizabeth Holmes has. How in the hell could you 5-star rate her fund? Oh, it's kind of like the Better Business Bureau, and if you join in and pay money, you really get a good rating? No kidding. Duh. Blows me away. So, with that said, William, thank you for letting me share that and so forth. Big picture. Fed chair. In fact, we have a Fed rate hike meeting coming up this week, I believe, right? No, let me see. It's not. It's not this week. It's next week. Is it next week? When is the Fed meeting? I thought I wrote it in here. It's this Wednesday. I got to look for it. This Wednesday, we have a Fed rate hike meeting, decision meeting. And pretty interesting because obviously nothing's going to happen right now. But we are figuring on 3 rate hikes next year, May, September, and December. A very good how to get stock market returns dialed in. Please read the big picture. Please take a look at what we have here. Go through and read it. I'll get this posted tomorrow. But plain and simple, a couple things I like, a couple things I don't like. The PE multiple was 24.1 by September 2nd. 18 is kind of where the multiple that we should be looking for. The S&P is overpriced right now. We will go back down to stock picking. Picking stocks with opportunity are going to be important. Cash flow. We will go through a bit of an economic slowdown. We're not going to go through a recession, but we will go through some type of economic slowdown. And if build better, bigger comes up, it won't matter. We're just going to keep going up because we've thrown another $1 trillion to $2 trillion at everything we're going. But to understand the Fed, how it affects the S&P, to understand where, yes, they're cutting back on mortgage-based securities, we'll raise 3 times. It's not the end of the world, but things will slow down. Please read the briefing, the big picture. This is going to be important for going into next year. I also have the market recap. Basically, hey, we're back up to our 25% for the year. Yippee. Dow Jones Industrial Average, still technically bullish, but we're turning again. We still have our positive on the RSI. We still have our positive on the MACD. We're relatively trying to catch up, and we probably do have our crossovers on a 5 and a 20, but we're holding the 50-day simple moving average. We're probably going to be up tomorrow, down Wednesday, up Thursday, flat on Friday for a flat week. S&P 500. We are also bullish. Same exact situation as the Dow. But on the Dow, if you notice, on the MACD, we were truly up. Right here, we're on each other. We've turned. We're looking to see things, well, again, I think the same thing. We're probably going to build a bit of a base. We have a week. Why not build a second week base? Have a couple weeks where maybe we get some nice retail end of the year push higher. Wouldn't surprise me. S&P 500, technically we're bearish. We just have our crossover here. If you had a 5 and a 20, you would just show a crossover. And we didn't even cross bullish in the last run up on the NASDAQ. We are still technically bearish on the NASDAQ. What do we have here for you? I still think we'll be down 3% in December. For earnings, we have Lennar and Trip.com, Adobe and FedEx on Thursday, Darden Restaurants on Friday. I do need to go ahead and put this in here. Fed FOMC meeting. Actually starts on Tuesday. I should say not meeting, should say rate decision. So not a whole lot tomorrow. Yes, we're going to find out inflation is a little high, especially with personal purchasing index and the core PPI. On Wednesday, Fed rate decision. So our markets will probably be flat. And then wouldn't surprise me to see a down day on Wednesday. Retail sales, retail ex auto, Empire Manufacturing, business inventories, NAHB housing market index. A lot happens on Wednesday. On Thursday, housing starts and building permits, industrial production capitalization. And on Friday, the monthly options expiration. And guys, at that point, big money's probably out. Big money's out. We're going to have less than ideal volumes. We might have some volatility, but big money will be out. The following week, GDP reports on Wednesday, consumer confidence reports next Wednesday, and then we have a slew of reports on Thursday, and our stock market's closed on Friday for Christmas. Slew of reports on Thursday, initial continuing claims, PEC prices, personal income and personal spending, durable goods and durable transportation, new home sales in Michigan sentiment on Thursday. With the big Wednesday and Thursday economic reports, we're still going to be on light volume, and big money is done for the year. So there's going to be next to no volume. Don't let a whipsawing day worry you next week. This is where they came up with that term, one day doesn't make a trend. And what they're really trying to tell you is, hey, low volume, what happens between before Christmas, the week before Christmas, and the week after Christmas, big money's out. Doesn't come in until a couple days after New Year's. That's why you usually see it 4 days after the New Year's is when the end of the Santa Claus rally will happen, and big money comes back in either to support the market or you'll see a pretty good drop. Don't let it bother you, is all I'm going to say. Costco had their earnings last week, did pretty darn good, I must say. I have a very interesting video. If you will click on this link, you'll have a little bit on Apple and how amazing Apple is. It's why it's one of our core holdings. Please go through and you'll be able to click on this and you'll have a video through CNBC on Apple's real iPhone demand. Someone that took the time to do the research to say, hey, Apple's still moving out there and the 5G growth is readily happening. Interesting article on Kathy Wood on Tesla, ARK Innovation, New Transparent ETF. Again, it's not beautiful. It doesn't look good. I'm also going to add in here, by the way, this one, because I think this one's a little more important. I found an interesting article that I do not exactly believe, but stocks head for a rare third straight year of double-digit returns. What happens next? Please feel free to read through this. It is rather interesting, and they have to go all the way back to 1928 for these kind of returns. Usually they go to 1950, 1951 after World War II, and those are the averages they're looking at. So just understand they're really going back quite a bit to find something that's interesting on 3 straight years of double-digit returns. That typically does not happen. I've included the pictures in here because it really is interesting, the research that was done. It'll be interesting to see where we end up next year. And I am excited that JP Morgan is set to pay a $200 million fine over lax staff monitoring. I think we also will see at least a $100 million fine coming up for Morgan Stanley in the near future. And it will be rather fun to see how they spin that one, is all I'm going to say. But with that said, what questions do you guys have? What questions can I answer for you that maybe I haven't answered for you, as this will most likely be the last time that you, well, it is the last time that you will be hearing from me for the rest of this year. Wow, there are a couple questions that came in. Let me get to my questions. All right, so question: what opportunities do you see for next year? So what are next year's opportunities? So that's what I will be trying to figure out as I run hundreds of numbers for stocks. Believe it or not, I still go and I still use, all right, let's see what I have here. Let's go to Burkert and Ward. And let's see if I've got my fundamental analysis. That is not what I'm looking for. I'm going to need to find it. I usually have a sheet that I spend my time doing some research, and it's just a one-page document. It's nothing that's all that fancy. But I do my research. And I try to find out see if I can find it. Intro classes. I'm not prepared, so I don't have it for you, but I usually do a one-page sheet that's fundamental analysis, where I look at ratios and I do my research to find out on hundreds of stocks if we still should be in what we're at, or if there's another opportunity. So the short opportunity, William, I don't know what they are yet, but I'll do my research and see what I like, and you'll hear me probably present that the second or third week in January. Do you look at insider buying and making your decision for a new stock? Yes. The short answer is yes. Insider buying is always important, as is insider selling. But I would obviously, it's not a make or break, but I like it when I see some increase in the insider buying of their stock. And I really like it when it's broad based, not just the CEO, not just the COO, but as you see it amongst all kinds of levels of upper management. That is something that is important for me to see. It just gives me the strength that the people are standing behind their company, but rarely, if ever, do you see that. So it's definitely not a make or break. It's just something that I'm taking a quick peek at. Thank you, Jim. I appreciate it. And thank you, Dave. I appreciate it. A couple compliments they gave to me, and I thank you. And also, you guys have a Merry Christmas. In fact, everyone, hey, have a Merry Christmas. Take a little bit of time off, and enjoy the holidays. Believe it or not, and you can't quote me on it, but there are things that are more important than the stock market. Only a couple, and Christmas is one of those. All right, are there any other questions I can answer for you guys? If not, I greatly appreciate you being with me here this year. I hope these are helpful. Going into next year, we're going to keep going with these commentaries every Monday evening. I also will go with the Thursday trade findings and adjustments, just so twice a week we're talking to you. You can see what we have. We're not always trying to find a trade. We usually have enough in place, but we will go through so that we can help you guys better understand what we're looking at and why we're doing some of what we're doing. All right, guys. Hey, have a wonderful evening. I appreciate you being here. As always, enjoy your Christmas holidays. Enjoy your New Year's holidays. We will continue to have accounts come over to Schwab. By the end of the year, we should be all set up where all accounts are over at Schwab, and we will go from there. Guys, take care of yourselves. Appreciate you being here. Again, have a wonderful holidays, and I'll talk to you here in a couple weeks. Bye-bye.